to the lunchtime live. I'm literally doing a question live, so I'm on the ACCA website, so there's no picture of me, so that's good news for you, I guess. So yeah, this is from December 23. We're going to try and do all of it. I might get some of it wrong because I'm doing it live, so let's see anyway. So hope you're all okay. And what we're going to do first of all for 5 marks is calculate an NPV. All right, so NPV basically starts over here on this left-hand side, and it says the initial investment will be 39 million. I'm going to do it in thousands, so that's 39,000. The finance director assumed there'll be 0 residual value, so I can ignore that. And working capital can also be ignored. And I can see here, look, there's 4 years. So let's make it bigger for you and squash this up so this becomes a bit bigger. All right, so year 0, year 1, year 2, year 3, year 4, maybe year 5 if there's tax involved. And in year 0, we've got this investment of minus 39,000. So far, so good. Okay, then it says the expected volumes of sales, so that's 60,000 units in year 1, 150,000 units in year 2, 140,000 in year 3, etc. That's units, and the expected contribution is 200 per unit and no inflation on it. So I can put in contribution. So contribution in year 1 would be 60,000, but I'm doing it in thousands, so 60 times by 200 each, 12,000. Year 2, look, we've got 150,000, so it'll be 150 times by 200. Year 3 would be 140 times by 200, and year 4 would be, what, 80 times by 200. And as I say, I'm doing this as, live, so we could be getting bits of this wrong, but let's see. So that's for that bit. Then it goes on to say incremental fixed costs, excluding depreciation, are 2.5 million in year 1. Okay, so I'll put in here fixed costs. And they're 252, 500, aren't they? But as a minus, doing it in thousands, so as a minus, yeah, in year 1. And then they increase in years 2 to 4 according to inflation. Inflation in year 2 is 6%, in year 3 it's 4%, and in year 4 it's 3%. Okay, so year 2 is 6%, so you take the fixed costs from last year, increase it by 1 plus, so 1 point, times by 1 point the inflation rate, in this case 0.6. Same in year 3, you take last year's and inflate it for the inflation rate this year. So times by 1 point, the inflation rate in year 3 was 4%, so 0.4. And in year 4, we do the same again. We take last year's and we times it by 1 point, and the interest rate was 3% in that year, so 1.03, and I'm done. Okay, then he says we pay corporation tax at 25% per year in arrears, so I will need that year 5. I pay corporation tax on profits, don't I? So I need to work out my profits first. So my profits would be from there. Well, I won't do it there. Actually, no need, is there? Profits would be from there down to there. Okay, and I'll just add that across. Now I can work out my tax. So my tax is payable in arrears, so year 1 is paid in year 2, equals minus, because it's a tax charge, that times by 0.25. Hopefully you're all still with me. Whoa. Okay, I might have to just close this down to 100% for a while. So that 2375, I'm just going to copy across like so. Okay, and I've done it. So that seems to be good. And then it says discount it all down at 11%. So to do the discounting, I need to work out my final cash flows. And my final cash flows is sum of, in brackets, from there, colon, to there. Because there was the original one was a subtotal, wasn't it? So I've done that, sum it all up. There's the sum of my cash flows. Now I want the present value of the cash flows. So I want to discount it down at 11%. Let's see if I can make this bigger for you. Yeah, it looks like I can. No, I can't, not really. Okay, so let's go back to 100%. Apologies for that, just the ACCA website. But okay, to get the present value of cash flows, which I will put, I'll make A bit bigger, and I'll put it here. Okay, what you do NPV, open your bracket, then the rate, which was 11%, so 0.11, comma. So you're saying to the spreadsheet, look, I want you to discount the following at 11%. And the following is from there, colon, to there. You never include your opening investment in this. So there's the present value of the cash flows. So my NPV, my net present value, would be those cash flows minus my original investment. Because that's a minus of minus to minus, but so let's just change that. Yep, so your NPV would be 5847.37. And I looked at this before, I'm pretty sure that's the right answer. So pat on the shoulder for me, and hopefully you all followed it. If not, just do drop a comment and we'll try and get back to you. Second thing said, right, calculate the sensitivity of that net present value to a change in the level of contribution per unit. So to a change in the level of contribution. Okay. Right. If the NPV, because we'll talk about sensitivity here, if NPV is 100, would you invest? Hopefully you're telling me, pardon me while I have a drink. Hopefully you're telling me, yes, I would invest because it's a positive NPV. And do you agree that in that NPV would be some sales? And those, let's say those sales were 1,000, but we would invest. So the next question comes along, and this is what sensitivity tries to answer. How much would sales have to change by to change your decision to invest? Well, by 100, wouldn't they? As soon as the NPV gets to 0, you kind of give up. You think, well, it's not worth doing it. So sales would have to change by 100, wouldn't they, for you to change your opinion? 100 out of the 1,000. Make sense? 10%. Let me do that again. NPV is 100. Would you invest? Yes, you would, because it's a positive NPV. Sales are this time 2,000, and you're asked to do the sensitivity on the sales. So how much would sales have to change by to change your decision? Well, 100 again. Sales have to change out of 100 to help, because if sales went down by 100, my NPV would go down by 100, and I wouldn't bother. So the sales would have to go down by the NPV divided by the sales this time makes it 5%. And the smaller the figure, the more sensitive it is, because the smaller the percentage has to change to make us change our mind. Okay, now it's a little bit tricky now. That was a bit of an oversimplification. Because what we're actually looking at, and what you'll be asked in the exam, like we were just asked, is the present value of the item. So it'll be the present value of the contribution that we're about to do in the exam. So what you do is you take your NPV and you divide it by the present value of the item. Divide 1 by t'other, get your figure, and that's your sensitivity. Okay, let's get back to the exam. So what I'm going to do here is I'm going to be a bit clever. Well, I'm not actually, there's no need. What I'm going to do is yes, I will. I'll be clever, so just to show you how you do it in the real exam. So copy that. Is that copy? Or is that paste? I can never remember. Copy that there and paste it there. So I've got another one to work with. So I'm going to work on this. Now I want to work on contribution. So contribution, I don't want my fixed costs, but I still want the tax, because if the contribution changes, the tax changes. So the present value of your item, when it comes to contribution, take off tax as well. So we've done it all. It's taken off tax, it's given our cash flows. The present value of those cash flows are 51,268. So it's as simple as that. We're trying to work out the sensitivity of the contribution. So we worked out the contribution there that was given to us. Then we took the tax off it, which was automatically, because I copied and pasted it. And that will give us our cash flows, we discount those cash flows down at 11% present value of those cash flows. So you're done. So that's where the spreadsheet really helps. So I said the way to work out the sensitivity is you take your NPV of the first, not this one because that one doesn't include fixed costs. So you take your original NPV, 58437. That's becoming as a percentage. I'll do it somewhere. I'll do it down here. So take your original NPV and divide it by the present value of the item, present value of your cash flows, 11.4%. So just change that to a percentage sign. We'll do it to 2 decimal points. 11.41. That's how sensitive the NPV is to a change in the contribution. Simple as that. Then it says, finally, calculate the sensitivity of the NPV to a change in the discount rate. Let me help you with that. So, NPV divided by the present value of the item, that is when you're doing like changing sales or changing contribution like we did. This is different. This is the sensitivity of a rate. So we made, let's say, NPV of 100 when the discount rate was 10%. How much would the rate have to change our decision to invest? Well, we discounted it down at 10% and it's getting to 100. We need more information. We need to know what would the discount rate be to get me to 0 then, because that's when I changed my mind. So if we said, well, 18% then, well, you can see the discount rate has to change by 8, which is 80%, isn't it? So that discount at 18 that 18% is actually the IRR, because IRR is when NPV equals 0. So what you've got to remember is you take your IRR when NPV equals 0, and I'll show you how you work that out in a minute. So that was 18% in our example, minus the original, which was 10%, divided by the original 10%. So IRR minus the original was 8, divided by the original 10. The rate has to change by 80% for us to change our mind. Let's get back to the exam question. So I'll do it over here. The rate we use, I can make this bigger. No, I can't. So let me get rid of all of that, because that was when we were doing the contribution, wasn't it? So I'm now going to do the IRR. And the IRR, basically, I need to put that minus 39,000. I need to just move it. You'll see why in a second. So the IRR you do equals IRR. So you're telling the computer, I want a formula that tells me the IRR. And I want it over all the cash flows, including the opening one. So you just say, right, tell me what the IRR is of there, colon, to there, the total cash flows. And if it tells me it's that, I'll turn it into a percentage. So it's telling me that the NPV would be 0, because that's what IRR does, if the rate was 18.4%. The rate at the moment is 11%. So if you remember, what I want is the IRR less the original divided by the original. The IRR, so 0.18, I'll just do 0.18, minus the original 0.11, 11%. Put those in brackets because you're just doing that. That's the change. And then what do you divide it by? The original 0.11. And you turn that into a percentage. And you say that's the sensitivity of the rate. If the rate changed by 60, in trouble, because NPV would be 0. And that's it. So in our little, however long we've had, 14 minutes, I've gone through an 11-mark question with you. I've taught you sensitivity analysis. And hopefully you found it useful. It is obviously very, very difficult to be doing a question and learning at the same time. So remember, this does get replayed on YouTube. It's on our YouTube channel. You'll find it under the live heading. Go there and watch it to your heart's content. Thanks ever so much, folks, and see you soon.